A retirement check can vanish without being stolen. Not because you lost eligibility, not because your benefit was cut, but because the money has nowhere left to go. In July 2026, 3 quiet financial changes are hitting older retirees at the same time. One affects how monthly Social Security payments are delivered. If the wrong people ignore it, their paper check may simply stop arriving. Another could protect up to $6,000 of income from federal taxes for one person, or $12,000 for a married couple. But most people will miss it because it is buried inside tax rules they will never read. And the third puts a hard limit on prescription drug costs under Medicare Part D. In 2026, once covered out-of-pocket spending reaches $2,100, the pharmacy bill for covered drugs can drop to $0 for the rest of the year. 3 doors are open right now. One protects your monthly deposit. One may increase your tax refund. One can stop prescription costs from draining your savings. But none of these benefits automatically reaches everyone who needs them most. So the real question is simple. Will you make the move in time? Or find out after the money is already gone? Money mistakes in retirement are different. At 35, a bad financial decision hurts. At 75, it can change how you buy food, pay rent, fill prescriptions, or help family. That is why these 3 changes matter. They are not investment theories. They are not stock market guesses. They are not maybe someday rules. They are direct, practical, and already connected to money older people depend on. A monthly benefit payment, a tax deduction, a prescription drug limit. Simple on paper. The problem is not that these rules are impossible to understand. The problem is that the system does not explain them in a way ordinary people can use. A rule appears in a government notice. A deduction hides inside a long tax law. A healthcare protection exists, but only people who know the correct program and application can unlock the deeper savings. And that is where retirees lose. Not because they were careless, because nobody told them what action to take. A headline does not set up direct deposit. A news clip does not claim a deduction. A rumor from a neighbor does not apply for extra help. The action does. So this story is about 3 actions. Protect the Social Security payment. Claim the senior tax deduction. Use the Medicare Part D cap. And check whether extra help can lower prescription costs even more. Each one sounds simple, but each one has a trap. And the first trap is the most urgent. Start with the monthly check. For millions of retirees, Social Security is not extra money. It is the foundation. It pays the electric bill. It covers groceries. It keeps medication on schedule. It keeps a roof overhead. So when the delivery method changes, that is not a small administrative detail. It is a survival issue. The federal government has been moving away from paper benefit checks and toward electronic payments. Executive Order 1424/7, signed in March 2025, directed federal agencies to modernize federal payments and phase out paper checks. The Social Security Administration began that transition with a key date of September 30th, 2025, and the broader goal of moving away from paper checks entirely by the end of 2026. That means the paper Social Security check is being pushed out. If your benefit already goes straight into a bank account by direct deposit, this first change may not require action. But if you still receive a paper check in the mail, this is not something to postpone. Because once paper payments stop, the government needs an electronic destination for the money. No destination means a serious risk of delay, and bills do not pause for paperwork. Think about the people most likely to still rely on paper. They may be the oldest retirees. They may not use online banking. They may have used the same routine for decades. They may distrust debit cards, websites, and automatic deposits. And they may be exactly the people who can least afford even one missed payment. That is the cruel part. The people most vulnerable to disruption are often the last to hear about the change. There are 2 main ways to solve it. The first is direct deposit into a checking or savings account. To set it up, you need your bank routing number, your account number, and your social security information. Those banking numbers are usually printed on checks, available through your bank, or visible in your banking records. You can arrange direct deposit through a My Social Security account online, by contacting Social Security, or by asking your bank for help. Banks handle this constantly. This is routine. This protects the payment. But what if someone does not have a bank account? That is where the second option matters. Direct Express. Direct Express is a prepaid debit card program for federal benefits. Instead of a paper check or traditional bank deposit, the benefit is loaded onto the card each month. The card can be used like a debit card for purchases, cash withdrawals, and regular spending. This matters because some people hear electronic payment and think, I do not have a bank, so I'm stuck. They are not. Direct Express was built for exactly that situation. But here is the twist. Some retirees resist electronic payments because a paper check feels safer. They can hold it. They can see it. It feels real. But the numbers tell a different story. A paper check is roughly 16 times more likely to be lost, stolen, altered, or returned than an electronic payment. 16 times. Mail theft targeting benefit checks is real. A check sits in a mailbox. Someone steals it. The ink is altered. The check is cashed. Then the rightful recipient has to prove the money never arrived. While that investigation drags on, rent does not wait. Medication does not wait. Food does not wait. Electronic payment removes that paper target. No envelope. No mailbox. No stolen check. There is also a cost reason behind the shift. Printing and mailing paper checks costs several dollars per check, much more than electronic payment. Across millions of payments, that becomes a large government expense. Whether someone likes the change or not, the direction is clear. Paper is ending. The U.S. Treasury allows hardship waivers in rare cases, such as extreme situations where someone truly lacks banking access. The waiver number is 1-877-874-6347. But that waiver is not meant for people who simply prefer paper. For most retirees, the safe move is direct deposit or direct express. Do not wait for the first missing check to learn the new system. Set it up while everything is calm. Because the worst time to fix a payment problem is after the payment has already failed. Now comes the second change. This one is not about keeping a payment from disappearing. It is about claiming money many retirees will never realize they are entitled to keep. A new federal tax deduction created in the 2025 tax law gives eligible seniors an additional deduction of up to $6,000 per person. That phrase sounds dry, but the effect can be powerful. If you are 65 or older by the end of the tax year, you may qualify for an extra $6,000 deduction on top of your regular standard deduction per person. A married couple where both spouses are 65 or older may be able to claim $12,000 in additional deductions. That means $12,000 of income shielded from federal tax, before considering other deductions already available. For many retired households, that can mean hundreds or even more than $1,000 saved. In some cases, it can be the difference between owing federal tax and owing nothing. That is not paperwork. That is rent money. Imagine a married couple, both age 67, with Social Security plus a modest pension. Their combined income stays below the qualifying threshold. Each spouse qualifies for the $6,000 deduction. They shield $12,000 from federal income tax. If their tax rate turns that into $1,000 or $1,500 of savings, that is not theoretical. That is insurance money, a property tax payment, several months of groceries, a repaired car. Now imagine a single retiree, age 70, living on Social Security and small withdrawals from savings. If her income is under the limit, she may claim the full $6,000 deduction herself. No complicated tax strategy, no itemizing, no box of receipts. Just knowing the deduction exists and making sure it is claimed. And this is where many people get it wrong. They assume big tax breaks only help people with mortgages, charitable deductions, business expenses, or complicated filings. Not here. This deduction is above the line. In plain language, That means it can be available even if you use the standard deduction. Most retirees use the standard deduction because it is simpler. This new senior deduction can stack on top of that, but there is a strict income test. For the full $6,000 deduction, modified adjusted gross income must be no more than $75,000 for a single filer, or $150,000 for married filing jointly. Above those amounts, the deduction starts to phase out. It shrinks as income rises. It disappears completely at $775,000 for a single filer and $250,000 for a married couple filing jointly. For many retirees, those thresholds may seem far away, but here is the hidden danger.
One unusual financial move can push income over the line. A large IRA withdrawal, a big capital gain from selling property, extra interest or dividends,
A pension lump sum, a retirement account distribution taken all at once. The income test does not look only at Social Security. It looks at the broader income picture. So, a retiree who normally qualifies could accidentally reduce or lose the deduction because of one poorly timed withdrawal. That is the trap. If someone is close to the threshold, spreading a large withdrawal across 2 years instead of taking it all in 1 year may protect the deduction. A decision made in November or December can shape the tax result in April. And there is another important detail. Married couples generally need to file jointly to claim it. Filing as married filing separately can shut the door. So couples should be careful before choosing a filing status. The action step is straightforward. When filing federal taxes on Form 1040 or Form 1040-SR, make sure the senior deduction is included, if eligible. If using a tax preparer, ask directly. I am 65 or older. Did you include the new $6,000 senior deduction created under the 2025 law? Do not assume. Ask. If using tax software, enter age and income information carefully. Do not rush through prompts that seem basic. That is where eligibility can be triggered. This deduction applies for tax years 2025 through 2028. If a qualified person already filed a return for one of those years and failed to claim it, they may be able to file an amended return using Form 1040X. That amended return can recover money that was missed. A couple over 65 could potentially miss $12,000 of sheltered income in a single year. Over multiple years, the lost opportunity becomes much larger. And the most painful part? They might never know. The IRS is not going to call every retiree and say, "You forgot this deduction." The system expects the taxpayer to claim it. The money may be available, but only to the people who know to ask for it. And the third change may be the most emotional of all, because it touches the cost people fear most. Medicine. For years, prescription drug costs created a brutal retirement problem. Some people could budget for housing. They could budget for food. They could budget for utilities. But then came one diagnosis, one medication, one specialty drug. And suddenly, the numbers exploded. A prescription costing hundreds or thousands of dollars could break a fixed income. Some retirees skipped doses. Some split pills. Some delayed refills. Some chose between medicine and groceries. That is the nightmare the Medicare Part D out-of-pocket cap is designed to limit. Starting in 2025, federal law created a $2,000 annual cap on out-of-pocket costs for covered prescription drugs under Medicare Part D. For 2026, that cap adjusts to $2,100. Once a person's out-of-pocket spending for covered Part D drugs reaches $2,100 in 2026, the plan pays 100% of covered prescription drug costs for the rest of the year. Not a reduced copay, not a smaller percentage. For covered drugs under the plan, the person pays nothing more for the rest of that year. That is a massive change for people with expensive medication. Take someone with a drug that costs them $500 per month out of pocket. Without a cap, that could mean $6,000 in a year. With the 2026 cap, covered out-of-pocket spending stops at $2,100. That is thousands of dollars protected, and for someone with very costly drugs, they may hit the cap early in the year, maybe spring, maybe even sooner. After that, covered medications can cost zero at the pharmacy counter through December.
That changes behavior. It can mean taking medicine correctly.
It can mean not delaying a refill. It can mean breathing again when the pharmacist rings up the prescription. But the cap has rules. The $2,100 includes the amounts paid out of pocket for covered drugs, deductible, copays, and coinsurance. Those amounts count toward the ceiling. Monthly premiums do not count. The premium is the cost of having the plan. It continues separately.
So the cap does not mean all drug plan expenses vanish.
It means covered out-of-pocket pharmacy spending has a hard annual limit. That alone is powerful. But for people with limited income and savings, there is another program that can reduce costs even further. Extra Help. Extra Help is the federal low-income subsidy connected to Medicare Part D and administered through Social Security. It can reduce premiums, deductibles, and prescription copays. For someone who qualifies, Extra Help can turn a painful drug bill into a manageable one. In some cases, medicine may become nearly free. The application is Form SSA 1020. People can apply through Social Security online or by calling Social Security. And here is the mistake that costs people money. They decide for themselves that they probably earn too much. They never apply. They rely on something a friend said years ago. They remember being denied before. But the rules have changed over time, and the income and asset limits are often more generous than people assume. Someone who did not qualify in the past may qualify now. Someone who thinks they are just above the line may be wrong. The only way to know is to apply and let Social Security calculate it. The application costs nothing. The possible savings can be worth thousands. So, if prescription costs are painful, Extra Help should not be treated as a last resort. Because the 2026 Part D cap limits the damage, Extra Help may reduce the damage before the cap is even reached. Together, they can be one of the strongest protections against medical cost shock in retirement. And that is the bigger story behind all three changes. The system has protections, but protections do not help people who never activate them. Here is the full picture. 3 money changes are in play in July 2026. First, paper Social Security checks are being phased out. If a benefit still arrives by paper check, set up direct deposit or request direct express. If there is a rare hardship situation, the Treasury waiver number is 1-877-874-6347. Second, the senior tax deduction can be worth up to $6,000 per eligible person, or $12,000 for a married couple where both qualify. It applies to people 65 or older by the end of the tax year, with income limits and phase-outs that can change the result. It applies for tax years 2025 through 2028. It can be claimed